Hi, Mark Dannenberg with Options Moneymaker here, continuing our discussion about simplifying your trading for bigger profits. One of the keys to simplifying your trading is using simple charting tools. There are literally hundreds of technical indicators out there and available for people to learn and try to figure out how to interpret in order to determine which direction the market might be moving, and which directional bias you want to trade, whether you want to open a declining bias trade or a rising bias trade. We promote a very simple approach, especially if you're just starting out learning options trading. You don't want to be overwhelmed with more and more technical indicators and not even sure how they're going to be interpreted and properly used for your own trading. We keep our trading as simple as possible using Bollinger Bands, support, and resistance. That's all we use to choose the directional bias of our trades and to choose the entry point for getting into our trades, as well as frequently we use them to determine when we should exit out of a trade. That's as simple as trading can be. So here's a snapshot of a chart. This is on the S&P 500, which you know that we trade as one of our three major indexes. The Bollinger Bands are these blue lines that weave their way through the chart. They're very easy to recognize and they're very easy to interpret when there is a potential movement in the opposite direction. So the Bollinger Bands tend to act as a barrier for the price movement of the index. The price moves back and forth between the lower Bollinger Bands and the upper Bollinger Bands. Now, it's not exactly specific that the minute it touches a Bollinger Band that it moves in the opposite direction, but it is so highly reliable and consistent that it is one of my favorite trading technical indicators, and one of the ways that we have been extremely profitable, particularly with our Profit Builder program. When you see the price of the index move to a Bollinger Band, it's most likely going to move in the opposite direction sometime in the near future. In addition to that, we use support and resistance. Now, a lot of people struggle trying to identify support and resistance and identify where those support points are versus where the resistance points are. And I'm going to try to make this very, very simple for you. Look for series of lows, low price points. And when you see a low price point that is followed by movement higher, that is what we call a natural level of support. Look at this series of lows in here. This series of lows was followed by a movement higher. That means that we have a series of price points that are confirming for us that that was a level of support. Then we have another series of price points that moved higher after that time period. That is another level of support. As we identify those natural levels of support, we connect them with a line, and that then defines our support of a channel. The other side of our channel is resistance. And what we see here is that we have natural levels of resistance where the price has moved to a high and then fallen off of that high. When you can connect natural levels of resistance together, you have the possibility of projecting out where resistance could possibly trade. When you draw both a support and a resistance line parallel to each other, what you're going to find on these indexes is that not only do they move back and forth between the Bollinger Bands, but they have a tendency to trade in a defined range. When it gets to the top of the range, it's highly likely it's going to reverse and move lower. That gives you an opportunity to take a declining bias trade. When it's at the bottom of the range, there's a likelihood that it's going to move higher, and that gives you an opportunity to open a rising bias trade. It is not 100% of the time that you can count on that movement, but it is so reliable that that is a very, very simple, very almost elegant way for you to be able to identify when to get into positions. Support and resistance occur in shorter time periods and longer time periods. When you have a series of price points that are moving lower, that's a declining cycle. You have a series of price points moving higher, that's a rising cycle. And those cycles will sit inside of a longer term channel that has its own level of resistance and support. So when you see a rising cycle followed by a declining cycle, followed by a rising cycle that is reaching a higher level of resistance, it is reasonable to expect, especially when you're trading at the upper Bollinger Band, that you're going to see a declining cycle coming soon. This is how you can start to predict which direction the market is going to move.